order types. There's really only two things that we can do in the markets: buy or sell. However, there are different ways that we can place our order to buy or to sell. The four basic order types include market order, limit order, a stop market order, which is a variation of the market order, and a stop limit order, a variation of the limit order. Let's first talk about a market order. Let's say that your sister is pregnant and she calls you because she's just gone into premature labor. You told her that you'd be there with her, and so you tell her, no problem, I'll be on the first flight out. So you go online to look up flights, and you see that the flights are currently $500 for the first flight out, and you're used to paying $200 to $300 for this flight. But you don't care right now about the price. It's important for you to be there with your sister, and so you buy the first flight available, regardless of how much it costs. What you've just done is you've placed a market order. A market order is one that does not have a price attached to it. It's considered an aggressive order because what we're essentially saying is that we don't care about the price. We want to get this order filled right now. We want to buy right now. We want to sell right now. For this reason, a market order is used to enter or exit a position immediately. This is the advantage here, that we get immediate execution. When you think about the flight to go visit your sister, it was important that you were on the first flight out, that you got this flight immediately. You paid a little bit more, but you're there for your sister. The downside is we may experience some slippage with a market order. Slippage is simply the difference between the price at which the order is sent and the price at which the order actually gets filled. So we may experience some slippage, but we get filled immediately. Now for a limit order, let's switch the scenario up a little bit. It's been a while since you've visited your family, and even though they're a little crazy, you'd like to pay them a visit. You go online to look up flights, and right now the flights are about $400. But you're used to paying between $200 to $300, remember? And you really don't want to pay more than $300 for this flight. There's nothing urgent about this visit. So what you notice is that on this website, there's an option that says, alert me if the price of this flight drops. Well, what you've done is you've just placed a limit order. You said, I don't want to buy this flight at $400, but I'm willing to pay $300 or less. This is considered a passive order because we're willing to wait for price to come to a point that we're willing to engage this market in. It's an order that is limited to the price that we specify as the trader. So what these are going to be used for is to specifically plan our entries and our exits into and out of a trade. The positive here is that we're guaranteed no slippage, and we may even get a price improvement. We're not guaranteed to get filled on the trade, but we're guaranteed that if we get filled, we will get filled at the price that we specify or better. So no slippage with this type of order. The downside is we may only get a partial fill, or we may not get filled at all. Now with a stop market order, what you'll notice is that this order has the word market in there, and that's because it's a variation of the market order. It's a market order that is triggered at a specific price. So what differentiates this from a regular market order is that it does have a price attached to it. This is that trigger price. So once this price is hit, it triggers our market order to be sent. Once sent, now this order functions just like a regular market order that seeks current price to get filled. It's going to be used for our stop losses to exit the trade. This is a good thing for us because as traders, it's going to be key that we're able to manage our risk. If the trade is going against us, we want to cut our losses short. We want to get out of this trade. And the stock market will ensure that if price is going against us, we get out. The downside here is that we may experience some slippage just like you have with a regular market order. Let's take a look at an example. We have a demand zone here where we want to go long. We want to go long at 34.30. Our stop loss on a long trade where we're buying to enter the trade is going to be a sell stop market. And that's going to be placed just beneath our demand zone at 34.15. So as price travels down and hits our entry point at 34.30, we will then enter the trade. Now if price continues even a little bit further and hits our stop price of 34.15, as soon as that price is hit, that will trigger the market order to be sent, the sell stop market order to be sent. And now it functions just like a regular market order, seeking the nearest price to get us out of this trade. Now let's take a look on the supply side. We have a supply zone where we want to sell short at 34.30. Now with a short trade where we're entering the position with a sell short order, our stop loss on the trade is going to be a buy stop market. And we're going to place this buy stop market just above the supply zone at 34.45. And so as price travels up into our supply zone, hitting 34.30, that's where we're going to enter the trade. That's where we're going to sell short. If price then continues even higher, hitting our stop loss at 34.45, as soon as it hits 34.45, that's when the stop market, the buy stop market order is sent. And now it functions just like a regular market order, seeking the nearest price to get us out at. Now for a stop limit. You'll notice that this type of order has the word limit in it. That's because it's a variation of the limit order. Now just like the stop market order, this has a trigger price. And so you'll see down here that we have two prices attached to this type of order. The first price, the stop price, that's going to be the trigger price. And once that price is touched, that's going to then send this limit order. And once sent, this order is now going to function just like a regular limit order. And as you know, with a regular limit order, this has a limit price, where we're saying we want to get filled at this price or better. We're not willing to go beyond this price to get our order filled. Now this order is not for the novice trader. It's not for the newer trader. It's important that if you're interested in this type of order, that you have some experience under your belt before trading with it live. What a stop limit would be used for is to automate a confirmation entry or a breakout. The positive here is that you may get filled at a better price. Remember, with a limit order, we're not guaranteed to get filled, but we're guaranteed that if we get filled, we will only be filled at the price we specify, that limit price that we specify, or better. But the downside is there's no guarantee that we will get filled. And so this could be very dangerous if we use it as a protective stop. Because if price is going against us, we want to get out. We want to cut our losses short and get out of the trade. The fact that this doesn't guarantee that we're going to get out means that we could incur a much larger loss than we had initially intended. So you'll notice even that this is only used on the entry side. It's not going to be used on the exit side of the trade. Let's take a look at an example. If we have a demand zone here where we're looking to go long, we could use a buy stop limit to place a number 3 confirmation entry. Now, a confirmation entry is essentially waiting for price to come into the zone, begin to turn, forming this bottom, and then as it's turning, confirming its change in direction. That's when the trade is entered. And so remember, with a stop limit order, we've got two prices here. We've got the stop price that triggers the order to be sent, and then we have the limit price, which actually details the price at which we're willing to get filled, only that price or better, not beyond that price. So as price comes into the zone, begins to turn, breaking this proximal line. Once it hits our stop price of 34.31, that will then send the limit order. And now it functions just like a regular limit order. That says we are only willing to buy at 34.33 or better, or lower. Now on the supply side, if we have a supply zone where we're looking to enter short or sell short, we could use a sell stop limit to enter with a number 3 confirmation entry. So what this would look like is as price is coming up into our zone and begins to turn, forming this top. Once it turns, once it confirms its change in direction, that's when the trade is then entered. So when price comes into the zone, begins to turn, leaving the supply zone in our direction, as soon as it touches 34.33, that's going to send our limit order. And our limit order has a limit price of 34.31, saying that we're only willing to sell short on this trade at 34.31 or better, or higher. We want to emphasize that this would only be used for an entry order for a number 3 confirmation entry. We're not going to be using this to manage our risk, or we're not going to be using this as our stop loss. For our stop loss, we're going to be using a stop market order. We want to make sure if this trade is going against us, that we're out, we cut our losses short. And to ensure that, we're going to be using a stop market, not a stop limit.